Okay, sorry about that. I wanted to divide the recording in two. I didn't want the information about that last section to spill over into the recorded lecture for this one. So you'll just notice on Blackboard that those will be divided into two separate video files. Okay, let's go ahead and in the last, I guess, 40 minutes or so of class today, move on to our last topic on what's called the term structure of interest rates. So, in our simple kind of supply and demand analysis of interest rate behavior from the last section, we examined a lot of the different factors that cause interest rates to change over time. But we did so in that model by looking at just a generic kind of bond market. That is, by looking at one interest rate at a time, okay? One bond market gives us one particular interest rate. But we know that there are many, many, many different types of bonds on which the interest rates on all of these different bonds can and do differ significantly from time to time. What I want to start doing for the rest of class today is to try to fill out or complete this model or this story of interest rates and how they're determined by examining the relationship between various interest rates to one another. So not just examine how an interest rate is related to its own demand and supply in one particular bond market, but how interest rates on a variety of different bond instruments are actually related to one another, okay? Now the main goal here is to understand why it is that bonds that have different maturities but are otherwise very similar to one another can have different interest rates. Now, just to be clear, what do we mean by the maturity on a bond? That's the date at which the par value has to be paid back to the bond bearer, right? We have bonds of a variety of different maturities that are traded in financial markets. Some bonds have very short maturities of just a month. Some bonds have really long maturities of as much as 30 years, okay? Why do these bonds that have different maturities but are otherwise very similar sometimes have dramatically different interest rates? That's the basic question that we want to think about. In other words, as an example, why is the annual interest rate on the 3-month Treasury bill different than the annual interest rate on the 10-year Treasury note? Those are two debt instruments that are similar to one another. They're both issued by the Treasury Department, but the only real difference is they have differences in maturities. Why are the interest rates on those two bonds different from one another? The relationship among interest rates on bonds that have different maturities is what's called the term structure of interest rates. We're going to spend the rest of class today and most of the next class talking about a couple of different theories of the term structure of interest rate. Once we understand that, then we're going to try to examine whether the term structure of interest rates provides any useful information about investors' expectations of what economic conditions are going to be in the future, okay? This is one of the most powerful uses of the term structure of interest rates, is that it actually gives us a peek, kind of a glimpse about what private investors think is going to happen to market conditions in the future. This is particularly important for central banks, who are constantly wanting to ensure that their policy announcements align with private sector expectations, right? That's the only way policies can be credible, if the private sector is able to expect what it is the central bank is going to do. Well, one very powerful way of analyzing those expectations is by looking at information that is provided by the term structure, all right? This is actually going to help investors use the term structure actually as a forecasting tool. And the final thing we'll do is we'll try to use the term structure to help us predict whether or not a recession is on the horizon. It turns out that in most of the last several recessions, they were all predicted given a particular feature or property of the term structure of interest rates that we'll get more into in the next class, okay? All right, so the central question then that we're interested in is whether or not bonds that have different maturities should be expected to have different interest rates. Why are they different, or should we expect them to have different interest rates? I think the only sensible way to try to answer this question is if we compare interest rates on bonds that obviously have different maturities, but are otherwise very similar, if not identical to one another, in all of these other types of bond characteristics. Now, bonds have a lot of different characteristics, not just maturity, right? For instance, different bonds have different amounts of default risk, right? Different bonds have different levels of liquidity. The tax treatment on different bonds can change, okay, from one bond to the next. I think if we're going to try to understand how maturity is related to interest rates, we need to try to hold fixed all of these other characteristics as much as possible. Okay, that is, we make sure that the two bonds we're comparing have at least very similar, if not identical, levels of default risk, liquidity, etc. Now, the theory that explains these differences is what's called the term structure of interest rate. Okay, it's defined as the relationship among interest rates on bonds that are otherwise similar but have simply different maturities. Okay, now what do you imagine is the easiest way to compare interest rates of different maturities but are otherwise identical in terms of their risk, liquidity, and tax characteristics? Probably we want to focus on U.S. Treasury bonds, okay? U.S. Treasury bonds of different maturities are all going to have the same default risk, that is zero, right? Most investors regard the U.S. government as being default free, risk free. Although liquidity is not identical, it's pretty similar. So 3-month Treasury bills are almost as liquid as money. It's a huge, huge market. Longer term Treasury bonds are not quite as liquid, but they're still highly liquid. So we can compare those, and they all have the same tax treatment. Interest is taxable under the federal income taxes. Okay, a common way then, or a popular way to analyze the term structure using interest rates on different Treasury bonds is by taking a look at something called the Treasury yield curve. Just by a quick show of hands, how many of you guys have heard of the Treasury yield curve before? Okay, so some, but not everybody. Let me be perfectly crystal clear as I can about what the Treasury yield curve is, because every semester I teach this, some students invariably screw this up, okay? I don't want you to screw this up. I want everybody to understand what a yield curve is actually saying. The Treasury yield curve shows the relationship on a particular day, at a particular point in time, among the interest rates on Treasury bonds that have different maturities, okay? It is not a graph that shows how the interest rate is changing over time. It is not a time series plot of an interest rate. It is a snapshot of the economy where it shows us the interest rates on Treasury bonds of all different maturities that are available and what those annual interest rates are at that moment. That is what the Treasury yield curve shows us, okay? Now, I can show you exactly what the Treasury yield curve is right now, and you can get that information easily by going to the Treasury Department webpage. So here's what the yield curve looks like for November the 16th. The annual interest rate on 1-month treasuries is 9 basis points, 10 basis points on 2-month treasuries, 9 basis points on 3, et cetera, et cetera. The 30-year Treasury bond has an annual interest rate today of 1.66%. Okay, now just that, I don't want you guys to get confused on the terminology, because you'll hear me say bills, notes, and bond. I think that anything with a maturity of less than 2 years is called a U.S. Treasury bill. Anything between maturities of 2 and 10 years is what's known as a Treasury note. Anything with a maturity of more than 10 years is a Treasury bond. So they're Treasury bills, notes, and bonds, but they're all bonds, okay? Yeah, so the bonds are, I believe, coupon bonds, right? The bills are discount bonds. So that's what the Treasury yield curve looks like. Again, it shows you the interest rates that prevailed today on all 12 of these different bonds, where each bond has a unique maturity, but all of the other characteristics like default risk and liquidity are pretty similar to one another. That's what the Treasury yield curve is. So don't mess that up, please. Here are a few examples of actual Treasury yield curves that I pulled from the data at points in the past. So the blue line shows the Treasury yield curve on September 10th, 2007. The red line is the yield curve on the same date, 2012, and then the green line is the Treasury yield curve, same date, 2019. So this shows you how the yield curve has actually shifted and twisted since before the financial crisis, all the way up to really before the COVID-19 recession. Again, make sure you guys can interpret all of this stuff, right? So for example, if I look at the September 2019 yield curve, it says what? That the interest rate on the 3-month Treasury bill is around 2%. But at the time, the interest rate on the 5-year Treasury note was around 1.5%. It does not say, again, that interest rates are declining over the next several months or years. It's not a time series plot. This can be confusing because one of the things we're going to go over later on today and in the next class is that indeed the yield curve does provide information about the future direction of interest rates, okay? But that's not how you interpret literally what's on the yield curve. It's a snapshot of all these different bonds at one point in time. A couple of points I want to bring up here. I want you guys to notice. Notice here that interest rates or yields on maturities were lower in 2012 than they were in 2007. So since before the financial crisis to after the recession and the recovery started, the entire yield curve shifted down, right? Now, most of that was because of the Fed's deliberate actions to try to lower short-term interest rates, which ended up having the effect of lowering bonds across the yield curve. Another point I want to raise is that in 2012, you see this nice kind of upward sloping yield curve. What does that mean? It means that interest rates on long-term treasuries were definitely higher than interest rates on short-term treasuries. So as for an example, the interest rate on the 3-month T-bill was like 0.25%. The interest rate on the 10-year Treasury note was maybe 1.75%, right? The difference between those two yields is sometimes referred to as the yield spread. So it was what, around 1.5 percentage points, something like that. The yield spread is the difference between a yield on a long-term bond and a yield on a short-term bond. The yield spread, you'll notice, is not always positive. In other words, the yield curve doesn't always slope up. There are times in which at least parts of the yield curve become inverted. 2007 and 2019 are perfect examples. Take a look at 2019. The interest rates on very short-term Treasury debt was around 2%. The interest rates on 3, 5, 7-year Treasury notes was around 1.75%. In that case, the yield spread became negative, which caused the yield curve to become inverted, all right? More on that later. Okay, questions about the yield curve. Everybody good with how to interpret it? Okay. The next graph I want to show you is not a picture of the yield curve, but is indeed a time series plot of the interest rate on two different Treasury instruments. The blue line is the 3-month Treasury bill. So that's the annual interest rate on 3-month Treasuries between 1970 and 2020. And the red line is the interest rate on the 10-year Treasury note. All right. The vertical distance between those two lines is the yield spread, right? It's the 10-year Treasury interest rate minus the 3-month Treasury interest rate, okay? Now, what you guys hopefully will notice from this graph, and this is important, very important, is that most of the time, not always, rates on 3-month Treasury bills have been lower than rates on the 10-year Treasury note. In other words, what does the yield curve look like? It is upward sloping. So most of the time, at least since the 1970s, the US Treasury yield curve has sloped up. Longer-term bonds have higher yield than short-term bonds. Now, the size of the yield spread fluctuates around a lot, right? You see that the distance between the red and the blue line is sometimes very small and sometimes is several percentage points. So the slope of the yield curve can change quite a bit, but most of the time it is positively sloped. Remember that. One of the things that we want our model of the term structure to be able to predict is that most of the time the yield curve is upward sloping. If it doesn't, it's not a very good model of the term structure. Occasionally, point 2, rates on 3-month T-bills have been higher than rates on the 10-year Treasury notes. In other words, from time to time, the yield curve becomes inverted. It has a negative slope. And you guys can see on the graph, if you squint real hard or look at your computer screens, when that happened. Looks to me like the yield curve inverted in the early 70s a little bit, in the mid 70s, in the early 80s, and right before 83. Where else was the blue line higher? Just a little bit before the 2001 recession, the yield curve inverted. It became slightly inverted before the great financial crisis and the recession of 08, 09. And if you look real hard, you'll see that the yield curve inverted ever so slightly and ever temporarily right before the most recent recession that we are probably currently in the midst of. By the way, I don't know if you guys noticed this, but the Fred website has historically put gray bars on all of these recessions, but they're using this beige color for the most recent recession. I don't really know what they're saying there. Maybe they just don't know if the recession's over or what, but clearly we are either in a recession or experiencing one. And hopefully you guys can see this. And again, this is going to be one of the major things that I want to talk about in the next class, is that before all of these past recessions, what do we notice happening? 6 months to a year and a half before the recession starts, the yield curve inverts. When you see an inverted yield curve, a lot of investors, that sends off siren sounds for them, and they think, oh my God, a recession's coming, right? And so it's in that sense, it's a useful forecasting tool about future economic conditions. And again, we'll talk more about why exactly that is later on. Last point I want to make about this. So again, our theory of the term structure needs to explain that the yield curve is usually upward sloping, occasionally will become inverted. But the other major thing it needs to explain is that if you look over time, interest rates on both of these two bonds basically move together, right? Not perfectly parallel, but during the 70s, the trend was positive. During the 80s, 90s, and 2000s, interest rates on all of these different treasuries were declining, right? During the last decade, the 10-year rate trended down, but you'll see that the 3-month T-bill was flat. And why was that? The ZLB, right? The zero lower bound. You can imagine if those interest rates could have become negative, they probably would have, right? But over the long run, we see that there's definitely positive correlation between interest rates on all of these different bonds with different maturities. So that's the third main feature that our theory of the term structure needs to be able to predict. Okay, and that's essentially the first thing that's on this next slide, is that if we are to develop a valid theory of the term structure, then it really needs to be able to successfully explain these basic three properties of the data. Long-term bonds are usually higher, so the yield curve is upward sloping most of the time. However, the yield curve can invert occasionally, and there definitely appears to be positive co-movement between interest rates of different maturities over time. That's point number 3. If our model is any good, it needs to do a relatively good job of explaining all 3 features. Now, economists have, of course, developed a number of different theories of the term structure. I'm not going to presume to discuss a whole lot of them. I'm going to discuss probably the 2 most prominent, all right? One is what's referred to as the pure expectations theory of the term structure, and the other theory builds on the expectations model of the term structure, and it's called the liquidity premium theory, okay? The expectations theory of the term structure really serves as kind of the foundation for understanding why interest rates on bonds of different maturities are related to one another, okay? Now, we will see when we fully finish talking about it that the pure expectations theory of the term structure does not successfully explain all 3 of these. It does have some shortcomings, which the liquidity premium theory of the term structure will attempt to rectify. But again, the liquidity premium theory just basically adds one extra component onto the pure expectations theory of the term structure. So that's what I want to do for the rest of today is really try to talk about the expectations theory of the term structure. Okay, basically what does it say? Let me define what this theory is. We'll talk about its assumptions and then try to derive its key prediction in the most intuitive way possible, all right? The expectations theory of the term structure says that interest rates on a long-term bond should be equal to the average of the interest rates that investors expect on short-term bonds over the duration of the long-term bond. Let me say that again. The expectations theory says that a long-term interest rate should be equal to the average of the interest rates that are expected to prevail on short-term bonds over the life of the long-term bond. In other words, the interest rate on a 2-year bond should be equal to the average of the interest rates on a 1-year bond today and whatever the 1-year bond is expected to be next year. You guys see how that works? The 10-year bond should be equal to the average of the interest rate on the 1-year bond today and the next 9 1-year bonds over the ensuing 9 years. That is the lifetime of the 10-year bond. That's essentially what the expectations theory of the term structure is saying. And don't worry, that sounds complicated. We will work through some specific examples and derivations here in just a minute. But these are the 2 key assumptions that underlie the expectations theory that you really need to understand. You can't really understand what this model of the term structure is saying unless you trace it back to these 2 assumptions. Number 1, in this model of investor behavior, all investors essentially have the same objective, and that is they want to maximize their holding period returns. Okay, now is that realistic? No. Investors don't necessarily want to maximize their expected returns because they care about other things like risk and liquidity and whatnot, okay? But for this simple model, we're just going to assume that investors are wanting to maximize their holding period returns, all right? The second and really more important assumption that leads to the basic results of the expectations theory of the term structure is that for a given holding period, investors view bonds of different maturities as being perfect substitutes for one another, okay? So, Jameson, if you are thinking about investing in the bond market for a period of 10 years, what assumption 2 tells us then is that you don't care whether or not you buy a 10-year bond today and hold it until maturity, or whether or not you buy a sequence of shorter term bonds, let's say a 5-year bond today, hold it until it matures, and then roll over all of the principal and interest into another 5-year bond and hold it until the end of the 10th year. Because the 5-year bond is a perfect substitute for the 10-year bond, you don't give a whit which of those two strategies you end up choosing. They're perfect substitutes for you, okay? All right, does everybody understand then the basic assumptions there? Because the essential prediction of the term structure, of the expectations hypothesis of the term structure, is going to follow directly from these two key assumptions. All right, let's work through then a simple example to illustrate exactly how this works. And that is why the expectations theory predicts that the long-term bond rate is equal to the average of the current and expected future short-term bond rates, and how this relates back to the assumptions that we've made. Let's suppose, okay, Jameson, I'm going to use you as my example here. Let's suppose that you have $1,000 that you want to invest in the bond market for a period of 2 years, all right? You have two investment strategies that you could choose from. One is what's called the buy and hold strategy. That is where you will purchase a 2-year discount bond today for $1,000, hold it until maturity, and you'll get the face value and interest back, okay? The other strategy you could adopt is the other one that I was talking about, where you could purchase 2 consecutive 1-year bonds and simply roll over the principal and interest into another 1-year bond over a 2-year period. That's what's referred to as the rollover strategy, okay? Now, let's take this one at a time. Jameson, what would be the future value of this investment, your expected value of this investment, if you employed the buy and hold strategy? You have $1,000 today, you buy this $1,000 face value bond, you hold it for 2 years at an annual interest rate of whatever it is. We can use the compound interest formula to figure out what the future value of this investment is going to be, right? It should be equal to your $1,000 principal payment times 1 plus the interest rate squared, right? Now, this interest rate term has a number in there and a subscript. So we need to be clear about the notation, okay? What does I subscript 2t mean? Don't want anyone to get confused about this. This is the annual interest rate on a bond that has a 2-year maturity that prevails in the current period, that is in year 1, let's say, in the current year, right? So if you were to go and look at the yield curve then, I2T is that interest rate on 2-year bonds that prevails right now. So Jameson, if you take this buy and hold strategy, you know exactly what your future value is going to be. It's going to be the $1,000 face principal payment times 1 plus the interest rate that you've been quoted squared. We're just applying the compound interest formula to figure out your future value. Easy enough, right? Okay. What if you adopt the rollover strategy? This is a little different, right? What is the expected value then of your $1,000 investment if you adopt the rollover strategy? And just to be clear again, Jameson, what you're doing here is you're buying a 1-year discount bond today for $1,000. You hold it until the end of the year, that is maturity. Then you turn around and you take all your principal and interest and you buy another 1-year bond, okay? And then you hold that until the end of the second year so that you're investing over a 2-year period. What would be your expected future value if you adopt the rollover strategy? it is going to look a little different, right? Well, here's your $1,000 principal. What's the value of your investment after 1 year? It's $1,000 times 1 plus I1T. That's the interest rate on the 1 year bond that prevails in the current period. To figure out your future value 2 years from now, you roll over all of the principal interest into another 1 year bond. Okay, but here's where things get a little bit more complicated. In the first year, when you decide to adopt this rollover strategy, you know what the current 1 year interest rate is. You know what the current 2 year interest rate is. You can read that off the Treasury yield curve. What do you not know? You don't know what the 1 year interest rate is going to be next year, right? That's what I1 T plus 1 is. That's the 1 year bond rate that prevails in the subsequent period, T plus 1. But because we don't know what that is perfectly, Jameson, what do we have to do? We have to form an expectation of what that interest rate is going to be. That's what the superscript E entails. That is an expected 1 year interest rate that prevails next year. Okay. Yeah. So the total expected value then of your investment would be 1,000 times 1 plus I1 times 1 plus the expected 1 year interest rate next year. Okay. Everybody understand the notation then so far? All right. Here is the punchline then. Under the assumptions then of this pure expectations theory of the term structure, the returns from the two strategies should be equal to one another. Why? Why does it not really matter whether Jameson picks the rollover strategy or the buy and hold strategy? Ultimately, what we're saying is that the expected value of the 2 year investment, the buy and hold strategy, should be the same as the rollover strategy. Why should those two things be the same? This all follows from one of the critical assumptions we've made about the model, and that is what? Investors regard bonds of different maturities as being perfect substitutes, right? So Jameson, imagine this was the situation. Imagine that the 2 year bond had a higher return than the 1 year bond. What would you and every other investor want to do? Buy the 2 year bond. That would be use the buy and hold strategy. So the demand for the 2 year bond would go up. That would lift its price and lower its yield. Simultaneously, what would happen to the demand for the 1 year bond? It would go down as investors were fleeing the bond with a lower return. That would lower the price and raise the yield. You see what's happening here? The movements in demand for these two assets would cause the interest rates on them to equalize. That process is what's called financial arbitrage. And it's what happens in a perfectly competitive financial market where the assets that are being traded are perfect substitutes to one another, right? This essentially says, this financial arbitrage process says that asset prices should fluctuate in order to equalize the holding period returns on assets that are perfect substitutes of one another, okay? So because investors regard bonds of different maturities as perfect substitutes, the main equilibrium condition that comes out of this model says that the buy and hold strategy should have the same expected value as the rollover strategy. Investors are indifferent between the two because of perfect substitution and financial arbitrage, and the fact that everyone's just trying to maximize their return. Well, now you guys can do a little math, right? So this is an equation that we can use to figure out the relationship between the 2 year bond and the current 1 year bond and the expected future 1 year bond. Divide the 1000s, they're gone. Stretch out the quadratic term. So it's 1 plus 2i2 plus i2 squared is equal to 1 plus i1 plus i1 expected plus the product of the two 1 year interest rates. The ones go away from the equation. Now, let me make one other quick little assumption here. When we're talking about interest rates, we're talking about numbers that are like, 2% or 3%, which is 0.02 or 0.03, right? Well, what is a number like that squared? 0.02 squared is what? 0.0004? Basically zero. In an economy that has moderate interest rates, these quadratic terms in this equation are effectively going to be zero, okay? So if we ignore them, and then we divide both sides of the equation by 2, look what we get. The interest rate on the 2-year bond is exactly equal to the interest rate on the current 1-year bond plus the 1-year bond expected next year divided by 2. In other words, it's the average of the interest rates on the short-term bond over the lifetime of the long-term bond. That's where the expectations theory of the term structure comes from. It assumes that investors regard bonds of different maturities as perfect substitutes, and that financial arbitrage equalizes the buy and hold strategy with the rollover strategy. When you do that, you're going to find that long-term bond rates must be equal to the average of the current and expected future short-term rates over the life of the bond. So for example, if the 1-year rate today is 2%, and 1-year rates are expected to rise to, let's say, 4% next year, then what must the 2-year rate be today according to the model? 2 plus 4 divided by 2 is 3. It's just the average of the current 1-year rate and next year's expected 1-year rate. So hopefully you already see here that if the 1-year rate today is 2 and the 2-year rate today is 3, that's an upward sloping yield curve. That is consistent with investors expecting future short-term rates to be higher. More on that here in a bit, okay? Now, more generally, you need to understand where the general formula for the term structure comes from. If we're dealing with an in-period or an in-year bond, the interest rate on an in-year bond should just be equal to the average of the interest rates on the 1-year bonds this year and over the next N-1 years, right? This equation then tells us how short-term interest rates today, which is given by this number, should be related to interest rates on longer-term bonds in the yield curve. In other words, if we want to interpret what we see on the Treasury yield curve, we can view that data through the lens of this term structure model based on the expectations theory of the term structure. Let me spend the closing minutes of class today talking about how we can potentially interpret the term structure using this thing called the expectations theory, okay? One reason, and I said this earlier, one reason why the yield curve is so important is that it gives us a glimpse of what investors expect interest rates to be in the future through all those expected interest rate terms in the equation, okay? So let me give you an example of what I'm talking about. Again, let's suppose, and this just builds on the example from the previous slide. Let's suppose that we go out and we read the yield curve today, and it says that the 1-year rate is 2% and the 2-year rate is 3%, okay? Then can we make an inference about what investors expect the 1-year rate to be next year? We can if we apply the expectations theory to this data. The expectations theory says that the 2-year rate should be equal to the average of the current 1-year rate and next year's expected 1-year rate. We can take this equation then and simply solve it for the expected 1-year rate next year, and it's 4%. In other words, what the yield curve has told us is that investors are expecting interest rates to rise next year. This is very important, right? Because central banks all around the world want to make sure that their policy announcements about the future course of interest rates align with private sector expectations. If the Fed announces that it plans to start raising interest rates over the next 12 months, then we want to make sure that that is actually reflected in the yield curve, that the private sector actually believes that the Fed is going to carry through those actions. What if we go back to the yield curve and we see that the current 3-year interest rate is 4%? Does that tell us something about what 1-year rate should be 2 years from now? Sure. The 3-year interest rate should be equal to the average of the current 1-year rate, next year's expected 1-year rate, and the expected 1-year rate 2 years from now. So that's 2 plus 4 that we found in the step above, plus this is the unknown variable. Well, we can solve that and easily find that it's 6%, right? So given a yield curve that has a 2% 1-year rate, a 3% 2-year rate, and then a 4% 3-year rate, so that it's upward sloping, that indicates that investors expect these 1-year bond rates to rise persistently from 2 to 4 to 6% over the next couple of years. Okay, do you guys have questions about that? So here's what we will do at the start of class on Wednesday. We will do, the next slide just basically kind of reviews this information about how we interpret the yield curve, how we interpret an upward sloping, inverted, and also a flat yield curve. What we're then going to do is immediately talk about why the expectations theory of the term structure is an imperfect model. It fails to explain one of the key features of the data that we talked about earlier. We will then build on the term structure, on the expectations theory of the term structure by developing the liquidity premium theory. That's not all that much more complicated. It just adds one little element to what we've done so far, and then we will use that to see how well it fits the data, and we'll analyze why yield curves tend to become inverted before recessions using that liquidity premium model. I should be able to get through all of this by the end of class on Wednesday so that you guys have all the content before your lab the week after Thanksgiving, okay? All right, see you guys on Wednesday.